I want to welcome everybody back to my show. This is The Mechanics of Money, episode 11. Before we begin, I want to make something clear. Everything discussed in this podcast represents my personal opinions and representation of economic events and financial markets. Nothing in this episode should be considered investment advice, trading advice, or recommendations to buy or sell financial instruments. Markets are complex systems influenced by countless variables. Every investor has different financial situations, risk tolerance, investment, and horizons. This podcast is meant for education and macro discussion and not financial advice. What we're doing here is examining patterns, signals, structured risks, and financial systems. Because once you understand how the system works, you begin to see things others miss. Welcome back to my show. This is The Mechanics of Money, episode 11. Today, we're going to go over what? We're going to go over the three T's, right? The three T's, again, for those who are new through my show, the three T's are the taxes, the tools, and the truth, right? In this particular case, we're going to go over the tools and the truth. What we're going to talk about today is the AI bubble. What you see here is the AI bubble innovation or speculation, right? Which is the prevailing question right now. We see basically the AI stocks are basically holding up the stock market right now. If you look at the market breadth report, about 98% of all the stocks are selling off, right? Only the mainstay, the Magnificent Seven, are holding up the whole stock market. Imagine that, right? So, and a lot of those stocks are AI stocks that are holding up the stock market right now, allowing the stock market to hit these record highs. So, what we got is the AI investment boom. We have the circular capital flows. These are the things we're going to discuss during the podcast, and warning signs from legendary investors. Next, we want to talk about the scale of AI spending. AI infrastructure spending has approached 1 trillion globally. Massive build out of data centers, chips, and power infrastructure. Tech giants allocate tons of billions annually to AI. And one key question is, can revenue justify the level of capital investments? And these are the things that we're going to discuss during this podcast. Now, what you discovered with the AI stocks is something quite interesting. What they call is a circular capital loop, right? And what exactly does that mean, right? What that means is that a lot of the revenue that goes into these AI stocks companies go around. Basically, what you see here is Microsoft pays OpenAI, Aver pays NVIDIA, and NVIDIA pays Microsoft. And it goes around in a loop over and over again. Same thing with Google. Google pays Anthropic pays Cloud pays NVIDIA, and NVIDIA pays Google, right? And then Google pays Anthropic, Cloud, NVIDIA, Google. So it goes around in a loop. It's a continuous loop that goes all the way around. One has to ask, is this what we have here, is this really real revenue that's going out? Because the revenue is not coming from the outside, right? It's not coming from outside sources, right? It's just basically one company. It's just what you have is money shifting from one company to another, right? In one particular case, one company wanted to invest in another company, but because they couldn't invest the money, the other company gave them an option to put up the money for them, right? So is that really, are you really investing the money in the company? The other company that you're supposed to be investing the money in is actually putting up the capital for you to invest in the company. So again, this is a self-fulfilling prophecy. The money is just flowing from one company to another in a circular capital loop. So we have many AI companies are spending money within the same ecosystem. It's in the This creates an illusion that there's high demand, strong revenue growth, rapid variation and increase. But much of the capital never leaves the system, and that's what's concerning, and that's what's catching the attention of Warren Buffett, Michael Burry, and Michael Lewis. They're looking at this and they're noticing that the money is not coming outside of this ecosystem. It's just one person, one company is paying another company to another company, and it's just circling around. So the same $5 billion is going around to the same company. So, but there's no real revenue being created. Now, here you go. Here's an example of what I'm talking about, right? You see the loop, right? And then you actually see the money that goes around from one company to the other, right? You see the ecosystem. And this is a wonderful depiction of the revenue loop that goes around, right? And this is very concerning of very respected investors are saying that a lot of these AI companies are very overvaluated, right? Their market cap does not meet their revenue that they're bringing in. Yes, next we're going to talk about the revenue and spending gap and how companies commit trillions of dollars and trillions in commit trillions in spending with limited revenue. The next topic we're going to talk about how OpenAI ecosystem revenue is $13 billion, right? It's $13 billion, but yet AI made commitments of $1.4 trillion. The math doesn't add up. You know, when the CEO was interviewed about it, they were questioning him. They said, "Well, how is it that you can make $1.4 trillion worth of commitments, but yet your revenue is only $13 billion?" You know, so they hinted at possibly getting a government intervention where the government will come in and help them, assist them in the process of getting this infrastructure that they need to grow the company the way they want. But which is concerning because OpenAI is a startup, you know. So why is it that a startup would have to need such a capital infusion when they're just starting up? They're just starting out, right? You know, why do they need so many $1 trillion to start out for capital infrastructure? Next, we're talking about Palantir. We're going to talk about the Palantir. Palantir market cap is 500 billion, right? But their annual revenue is 4.4 billion. So there's a disconnect, right? Their valuation is 500 billion, but their annual revenue is 4.4 billion. Again, this is the concern that Warren Buffett and Michael Burry and Michael Lewis is talking about, right? For every 100 investors pay $100 for $1 worth of sales, right? So it doesn't, the math doesn't meet out. It doesn't meet out. Why? How is it that how is it that you're paying $100 for a stock that's only generating $1 for sale? So next we're going to talk about understanding the PE ratio, right? The price to earnings. What we notice with the AI stock, the PE ratio is very high opposed to the average PE ratio, which is about 20 to 25. In this particular case, the PE ratio is very high for these particular AI stocks, and this is what is concerning Warren Buffett and Michael Lewis and Michael Burry, is that the PE ratio is really high, and the revenue is not commensurate of what is actually happening on the ground. So people have to, it's concerning because at what point when the correction comes and the numbers come, kind of correct themselves, then we're going to actually see the true numbers, and then potentially people could lose a lot of money in their investments. Here we have a chart of the valuation and the reality, right? You look at Palantir. Palantir is the price to sales ratio is 102. How about that? So you pay $100 for every dollar worth of sales. You talk about a bloated and inflated valuation. You can't get any more than that, which kind of which kind of follows what the Warren Buffett indicator talk about how a lot of these stocks are highly are overvalued, right? This is the highest it's been in history in terms of the overvalue of stocks. So this chart really is telling. As you can see, the market cap again is 500 billion, but their annual revenue is only 4.4 billion. So the net margin is 40%. Here's another chart basically saying the same thing, just looking a little bit different, right? What is interesting is that I want you to focus. I want you to focus on the bottom here, right? But what you see on the bottom here is that there is no path for Palantir to make 200 billion profit by 2030, right? That is really telling that they cannot make 200 billion in profit by 2030, but yet there's speculation and the market cap is 500 billion. So it just the numbers don't make sense. It doesn't make sense. Nothing adds up in this particular case. When you have the valuation and when Warren Buffett's quote, when valuation disconnects and violently from the fundamentals, history shows one outcome. Mr. Market sobers up, and then the hangover is brutal. So that's what Warren Buffett's talking about, is that as everybody piles into AI, one thing they're not looking at is the fundamentals are telling you that something is not right. Something is not making sense here with the AI stocks. And this is Buffett's warning, right? Technology can change the world, but that does not guarantee good investment returns. And when valuation disconnects from fundamentals, the market eventually corrects. So that's what he's talking about. So the market corrects. So when it corrects, then potentially people can lose their money. So that's what people have to look at. They have to consider that when the market corrects, and it looks like as we go from level 2 and get ready to move to level 3, that as the shadow banks are starting to collapse, and we're having a credit freeze, and we're having more redemptions, and there's a freeze on redemptions, then we have to wonder what effect this is going to have on the Magnificent Seven that ultimately is holding up the stock market right now. Here's Michael Burry's perspective. Parabolic prices increase, rarely stabilize. So rapid corrections. There's going to be rapid corrections, valuation compression, and investor panic as prices of the AI stocks do not stabilize, right? There's going to be these kind of things that's going to be happening in the market. We got execution problems. A major issue is enterprise AI adoption, pilot programs, experimental tools, and cost centers. Up to 95% of generative AI initiatives produce no measurable ROI. That's huge, right? That's huge. They said 95%, right, of generative AI initiatives produce no measurable ROI. Here are some of the first warning signs that AI is going to start to stumble. When AI expects fail to translate into revenue, layoffs in AI division. So we've already seen layoffs going on with Amazon and other AI companies. We have hire freeze for data scientists, and we've seen reduced R&D budgets as well. Hardware infrastructure risks. AI depends heavily on infrastructure, GPU, chips, data center, power grids, semiconductor, or fabrication plants. Competitive disruption and another risk. New technologies can disrupt current hardware economics. Example research suggests that example research from China suggests that analog AI chips could be up to 1,000% faster if true, it could disrupt the existing GPU economics. So that's huge because ultimately China just came out and said their chips are 1,000 times faster than the U.S. chips. So that could really upend the AI market because they would no longer need our chips, right? And that's what's happening on the ground right now. That's what's happening, and shorten life cycles of the current AI hardware. Okay, we have the bubble exit signals. Watch for these indicators: a widened AI layoffs, insider stock selling, a venture capital slowdown, media narrative reversal, chip oversupply, and when several occur simultaneously, investors' confidence could collapse rapidly. And what you see here is a plausible AI scenario that could take place within the 18 months, right? As we have so much uncertainty with the war, we have Iran. One thing that came out of the Iran war is Iran is sending a lot of drones over into Israel and into U.S. bases. The thing is that a lot of those drones that Iran is using do not cost that much. They're using motorcycle engines, right? But we're using the missiles that we're knocking down. These drones are cost us millions and millions of dollars, right? To knock down these drones that does not cost Iran that much money. So basically, we're talking about a war of attrition, right? It's we can kind of spend ourselves out of this war, which could have a direct effect on the economy and ultimately could lead to a collapse of the market if this turns into a long extended war. So we have to keep our eyes on this stuff, and this could be a plausible AI bubble scenario that we're dealing with. Now for the final thoughts. Now we have the final thoughts. You can, again, the name of my firm is Fiagli Financial LLC. You can call me at 832-453-7260. I am the CEO. I do tax preparation and tax planning and bookkeeping. What we have here is the national debt, which is almost 39 trillion, right? Once we get the check, once the waiter gives us a check for the war, I imagine that the national debt will be jumping up significantly, right? Now, let's talk about some quotes, right? Let's talk about some quotes. Just like the dot-com bubble, the AI bubble could end badly if people are investing in hype rather than fundamentals. That is Michael Burry, okay? Also, Warren Buffett. People get excited about things that change the world, but that doesn't mean that investors in those companies will make a lot of money. And that's what Warren Buffett is talking about. And that is the purpose of this podcast, right? It's not that a lot of people might scoff and say, well, AI is doing great in stocks. Yeah, but the thing is revenue is not meeting the market cap. So it doesn't mean there's a disconnect. It doesn't, at some point, things are going to have to true up, right? They're going to have to, the market cap is going to have to relate to the revenue. And that's the problem. And that's what everybody's talking about, Warren Buffett and stuff like that. When we talk about the Warren Buffett indicator, that at some point that we're going to have to, it's going to have to be trued up. We're going to have to actually see and recognize the true value of these companies. So we have that. Then we have a quote from me. Every technological revelation creates two things: a real innovation and speculative excess. The difficulty for investors is separating the two before the crowd does, right? So you have to be able to, you're fine now, but you have to know when it's time to get to the exit, right? You have to know when to walk away, right? So, everything's fine now. Yeah, the market is hitting record highs. But just don't, just like Warren Buffett says, don't get caught when the water, when you have withdrawals, right? Drawback, right? When there's drawback, you don't want to get caught in that. So, so the final question is, AI may still transform the global economy, but investors must ask: are we witnessing a revolution or the largest technological bubble since the dot-com era. So I had fun talking to everybody. Thank you for watching my show, and hopefully you watch my next episode. You take it easy.